There's a lot we could say about this debate that we just don't have time to get into, unfortunately. But for those of you who aren't familiar with this period of economic history, in the 19th century in Britain, there was a heated discussion that spanned several decades between two schools of thought that became known as the currency school and the banking school. And to some extent, there's also a free banking school, but that's not relevant for my paper. But basically what they debated was how to regulate the Bank of England and other banks of issue so as to mitigate, if not eliminate, financial crises and prevent the inflationary overissue of banknotes. So what matters for us is that in the process of doing this, they discussed several important problems in monetary theory that appear again and again in the history of thought. So I'd like to just talk a little bit about some of these problems and how they influenced monetary theory just after the turn of the century. In particular, I'm speaking of Mises, who I assume all of you know, Joseph Schumpeter, student of Böhm-Bawerk, but also heavily influenced by the Lausanne School, and Rudolf Hildering, the Austro-Marxist economist. All three came from similar backgrounds. They were all students in Böhm-Bawerk's seminar at the University of Vienna, and they all published important books relating to the currency banking debate in consecutive years. Hildring's Finance Capital appeared in 1910, Schumpeter's Theory of Economic Development in 1911, and Mises' Theory of Money and Credit in 1912. In terms of their relationships to the earlier schools, Mises is essentially a disciple of the currency school. Hildering is an orthodox banking school theorist within a broader Marxist framework. And Schumpeter is somewhere in between, taking little bits and pieces from each school. So we'll begin with Mises and the currency school. As I said, the doctrines of the currency school were developed in early 19th century Britain, principally by Lord Overstone, George Norman, and Colonel Robert Torrens. And they built their system around the idea that additional legal restrictions are necessary in addition to convertibility to ensure that banks couldn't overissue their notes. The central doctrine of the currency school became known as the currency principle, which states that the quantity of notes in circulation should be made to adjust in volume exactly as a purely metallic currency would. Or in other words, there's always a danger of an overissue of banknotes, which should therefore be strictly regulated, so regulated that the notes might become mere tokens for metallic money. So the idea is that there has to be some sort of restriction on the creation of banknotes to prevent inflationary overissue and avoid or at least mitigate business cycles. And by the way, when I say inflationary, I mean it in the sense that Mises uses inflation in the Theory of Money and Credit. So the currency school had several ideas about monetary rules that could be imposed to limit the powers of banks, mostly revolving around some sort of fixed, absolute amount of specie and securities that should be held in reserve by the Bank of England at all times. The rule they finally settled on was sort of a variation on 100% reserve banking, but it applied only to bank notes and not to bank deposits. So the currency school writers were also early quantity theorists as opposed to the banking school and Hildering, we'll talk about in a minute. But the currency school theorists were, as Mises described them, mechanical quantity theorists. That is, they still implicitly believed in the neutrality of money. The currency school writers, especially Torrens, believed that the overissue of banknotes led to financial crises, but they didn't really have a very clear idea of how business cycles worked. They knew that overissuing banknotes caused rises in prices, changes in the rate of interest, the export of gold, and they knew that financial crises were somehow related to these events, but they didn't really have a cogent theory of boom and bust. In a way, so they essentially had the beginning and the end, but not the middle part. Especially towards the end of the debate, actually, this became a serious problem for them. There was a lot of equivocation among the currency school about the claims they had made about the relationship of banks to the business cycle and so on. So it represents a serious theoretical hole in their system. So in this regard, Mises, of course, makes a great contribution with the Theory of Money and Credit, which, appropriately enough, in the original German, actually translates to the Theory of Money and Fiduciary Media, which, of course, is what this debate revolves around. Mises takes some of these ideas that were used by the currency school and incorporates them to a more comprehensive theory of money and cycles, especially, of course, the notions of non-neutrality of money and Wicksel's interest rate theory. And of course, the result is Mises' early business cycle theory, which of course explains how the divergence of interest rates induces malinvestment and so on and so forth. Now, while Mises did accept much of the currency school's doctrine, he was fond of pointing out that there were two great errors in the currency school's system. The first error was the currency school falsely believed that a central bank was the only method of limiting the inflationary overissue of notes. And the second error was that the currency school didn't realize that banknotes and demand deposits actually perform the same economic function. So this second problem, the distinction between notes and deposits, was corrected by the banking school, who realized that notes and deposits are money substitutes in the same sense and perform the same economic function. But whereas the currency school had supported legal restrictions on note issues, the banking school thought that additional regulations were neither necessary nor desirable. Their reason for opposing legal restrictions is summed up in the so-called banking principle, which holds that the amount of paper notes in circulation is adequately controlled by the ordinary processes of competitive banking, and if the requirement of convertibility was maintained, could not exceed the needs of business for any appreciable length of time. This notion of the impossibility of overissue is supported primarily by what became known as the law of reflux. This notion was invented by John Fullerton, who was a leader of the banking school, and was later adopted by other banking school theorists like Thomas Tooke and John Stuart Mill. The law of reflux is the idea that the quantity of money always conforms to the needs of trade, that is, the business demand for money. And thus overissues are impossible because the supply of money substitutes will either expand or contract with the demands of business. So this elasticity is the fundamental characteristic of banknote issue, and there's therefore no regulation of the currency is necessary to prevent overissue. I think the principle is relatively straightforward. The idea is that in order to issue loans, somebody has to accept them. So if the demands of business don't require additional credit, any notes printed in excess of demand will simply flow back to the bank. So there can't be any inflationary issue of bank credit. And it's not that the banks don't inflate, it's that they can't, even if they try their little hearts out. Now, obviously, there are a lot of problems with this, but the main one I'll mention is that this implies that the demand for money is somehow independent of the bank's policies. I mean, of course, it's the case that businessmen have to be willing to borrow from banks in order for the banks to be able to lend, but obviously the bank's lending policies are seriously going to affect the demands of business through interest rates. But this brings us to Hildering, who picks up on this banking school position and adopts it really without any changes. Hildering was following Marx on this. They had both accepted many of the doctrines of the banking school. I think Marx somewhere describes Hildering as one of the best bourgeois economists. Now, of course, Hildering and Marx had also both denied the quantity theory of money and accepted the banking school's belief that the quantity of money is determined endogenously by business demand. So it's not really, I suppose, surprising that they would have denied the quantity theory and picked up on this banking school doctrine, which is much more compatible with the labor theory of value. Banking school theorists had also denied that monetary factors influence business cycles, holding that crises emerge in the so-called real economy. Hildering agreed and attributes crises to either supply or demand shocks, which in the Marxist vocabulary means that because of problems inherent in the anarchy of capitalist production, discrepancies tend to appear between the production of producers' goods and consumers' goods. But interestingly, Hildering takes this faulty starting point and lays out a sort of a overinvestment theory of business cycles that emphasizes the heterogeneity of capital and the intertemporal misallocation of capital. And he actually reaches some conclusions that are very similar to Mises, but especially the younger Hayek. But his whole outlook on the process of the cycle is completely different from Mises and very much flawed. In fact, Hildering reviewed the theory of money and credit when it came out. Actually, his review was really just 3 or 4 pages of diatribe against Menger, Bavark, and Wieser and the marginal utility theory. But at the end, he sneaks some paragraphs in where he criticizes Mises for accepting the currency school's doctrine and denying and accepting the quantity theory of money and denying that banks exercise any real control over the money supply or interest rates, and Hildering just denies this without really explaining why. But it's actually, Hilferting's not all bad. In Finance Capital, he actually does have some intriguing things to say about how banking institutions affect the rest of the economy. He talks quite a bit about how the banks, by issuing credit to businesses and combining banking capital with industrial capital, encourage the dependence of business on the banks, and gradually the banks consolidate a sort of monopoly position for themselves and for their favored firms. And this idea is how Hildering avoids Marx's traditional problem of explaining how under capitalism business cycles would become more frequent and more severe, leading eventually to the collapse of the system and the replacement by socialism. Hildering says, well, it's since the banks are constantly consolidating their position, all that we need to do is just wait it out for a little while until the banks control essentially everything, and then we can just have the state take over the banks, and we'll get the end of capitalism and the rise of socialism through a sort of bloodless revolution in the banking sector. So that's intriguing. Interestingly, Schumpeter actually criticized Hildering on this later on in the History of Economic Analysis. But as I say, the lady doth protest too much, methinks, because Schumpeter had said some very similar things a few years earlier in Capitalism, Socialism, and Democracy. But that's just a side point. But on to Schumpeter. As usual, his position is the most difficult to pin down in terms of affiliation with one school or another. He occupies kind of a middle ground between the currency and banking schools. But if you're familiar with Schumpeter's book, The Theory of Economic Development, you know that he builds a theory of the static economy and then uses the idea of the entrepreneur to explain how innovations disturb the static equilibrium and shift the entire economy to a new equilibrium point. This is important because in Schumpeter's schema, the only way to stimulate economic change is for the banks to create new credit that the entrepreneurs can use to finance their innovations. And the reason this is relevant is because since entrepreneurs can only produce in the future, there's this lag between the introduction of new credit and the introduction of the new goods that the entrepreneurs produce. So this is actually one difference between Schumpeter and the banking school, because whereas Fullerton and Tooke and the other banking school theorists held that the quantity of money is determined endogenously, Schumpeter is emphasizing the role of banks in creating creating money exogenously, and he actually says that the only real purpose of banks is to create credit for the entrepreneurs. So in this sense of exogenous money, he's closer, I think, to the currency school. But then, on the other hand, he's close to the banking school because he does see banks as expanding credit only in relation to the needs of business. And in this case, the needs of the entrepreneurs. But then he clearly supports the idea of the quantity of money affecting prices independently, which the banking school emphatically denied, because the banking school denied all forms of the quantity theory. And then again, on the other hand, the currency school would argue that Schumpeter's innovative bank credit creation is inflationary, whereas Schumpeter develops a rationale for why that's not necessarily the case. He claims that the whole operation from credit creation ultimately up through the entrepreneur's new production can be either inflationary or deflationary depending on the circumstances, but he doesn't really take a clear stance. Although on this argument he is more convincing than the simple reflex explanation that the banking school used. He also improves on the banking school in some ways, because he does actually admit that expanding the supply of credit will, at least in the short run before the introduction of new goods, be inflationary, which is something, again, that the banking school denied because of this idea of the reflux. And the banking school had denied this because they didn't take into account the length of time that it would take for the reflux to work. It's obviously not instantaneous, so even if it was the case that this reflux operates all the time, there's still a lag between the time when the new money goes out and when it redundant and returns to the bank. So, and then finally, the last thing I mentioned is that Schumpeter's innovation-based theory of the business cycle is very similar to Hildring's in the sense that both cycles begin with radical changes in the economy. In Schumpeter's case, the entrepreneur, not a simple demand or supply shock or something like this. But and so in this regard, again, it's a real theory of the business cycle, which is much closer to the banking school as opposed to monetary explanations of the currency school. So so I suppose that was quite a bit to get through in just a few minutes, but I hope I've laid out some of the simpler, basic connections between these two periods, these two debates in the history of thought. I'd just like to conclude by saying that there is actually some current relevance to this. It's not just a bland exercise in the history of economic thought. The central issue that came out of the currency banking debate, this question about whether or not we need special legal restrictions on banknotes or on bank issues in general, is also at the center of the debate between the 100% reserve-free bankers and the fractional reserve-free bankers. Now, I realize that debate is so 1988, but it is actually important. And even though the dispute has taken many twists and turns through ethical and juridical arguments over the years, I just wanted to emphasize the importance of the strictly economic arguments. And at the core of this dispute is the same issue that was being discussed by the currency and banking schools. And in my opinion, fruitful continuation of this discussion should revolve around investigating this economic question further. So, thank you.